The Bank of Canada has decided to raise its benchmark interest rate from 4.5% to 4.75% on June 7th, bringing the benchmark to the highest level it's been since 2001. This move came as a surprise to many people, as the consensus view was that a rate increase was likely to happen later in the year. This is the first time the Bank of Canada has raised the interest rate since January's rate hike, where the bank signaled it would temporarily hold the interest rates to see how inflation responded. Since we saw the 40-plus year high inflation rate of 8.1% in June of 2022, we've seen a consistent drop in inflation until April of 2023, where the inflation rate once again increased from 4.3% in March to 4.4% in April. Up until April, the rate increases over the last year have had a positive effect on the inflation rate, but we're still far from the target of 2% that the Bank of Canada is looking to achieve. In that same time frame, the average home price in the GTA dropped to a low of $1,038,000 in January, but since the bank indicated a pause of rate hikes following January's rate announcement, the GTA has seen steady month-over-month price increases. According to the Canada Mortgage and Housing Corporation, at the beginning of 2022, 56.9% of Canadian mortgages were on a variable rate. But that number dropped to 44.2% by the second quarter of 2022, with the number likely to have fallen lower since then. But that's still a significant chunk of Canadian homeowners who have seen major increases to their monthly mortgage payments, or have reached their trigger rate, which means their payment each month is essentially only going towards interest and not actually paying down the principal. Homeowners and variable rate holders are not the only ones feeling the heat, though. Renters are also seeing their monthly costs increase quickly as well. In January, the CBC reported that the average Canadian rental cost had increased more than 18% last year for new tenants. Many landlords are being put in tough positions where they're either operating at a loss each month, they raise the rents to try and cover some of the additional costs, or they sell the property. And a landlord selling their property means one more tenant is added to the actively searching pool of renters in the market, and a rental unit has come out of the market as well, further restricting supply and increasing demand for rentals in that area. Either way, many renters are getting the short end of the stick too. According to the CBC article, the rate hikes since last year have already added more than $1,000 to the monthly payment of a $500,000 mortgage. And according to co-chief executive of RateHub.ca, James Laird, he estimates that a homeowner who put 10% down on a $716,000 home with a 5-year variable rate of 5.55% over 25 years will see an increase in their rate to 5.8% and an increase to their monthly payment of about $98. Which doesn't sound like much, but when you factor in that a chunk of variable rate holders may have purchased in 2022 at a much lower rate, their monthly costs have likely increased well over $1,000. And those who have fixed payments on their variable rate mortgage will likely exceed their trigger rate if they haven't already. According to an analysis from the Bank of Canada last year, half of variable rate holders hit their trigger rate in October, and an estimated at the time 65% of variable rate holders, or 17% of all mortgages, would hit their trigger point in mid-2023. So with so many Canadian homeowners seeing dramatic increases to their monthly mortgage payments, how can they afford to keep their homes? Well, in the United States, it's not uncommon to see mortgages with an amortization period longer than 25 years. But here in Canada, the standard period is 25 years, but with all of the rate increases, almost 1/3 of homeowners with a mortgage will now pay off that debt over a more than 30-year period. With some homeowners able to receive an extension for periods up to 40 years, according to TD's Senior Manager of Public Affairs. Many homeowners with variable rates have requested to extend their amortization period in order to maintain their current monthly mortgage payments. This can prevent homeowners from defaulting on their home for missing payments due to the increased mortgage costs, which means less forced sales hit the market, but also means their home will be paid off slower and more interest will be paid over the duration of the mortgage. Allowing extensions means more homeowners who would struggle with payments can keep their homes, but it also means that home prices won't correct in an environment where they normally would, which is causing these lenders to come under scrutiny from many people. Lenders making exceptions is great for the homeowner, arguably not so great for the market long term, as it just kicks the problem down the road. According to OFSI, the Office of the Superintendent of Financial Institutions, these extensions don't come without risk, and in its recently released annual risk assessment report, housing is listed as the #1 risk it's monitoring in the coming year. And it's actively assessing the risks posed by variable rate fixed payment mortgages to determine whether changes are needed. They could potentially force lenders to move homeowners back to their standard and contracted amortization period when they have to renew to help lessen the risk. An OFSI spokesperson said while increasing amortization is one way to cope with the higher interest rate hikes in the short term, it's not without risk. Extended amortization will lead to greater persistence of outstanding balances and greater risk of loss to lenders. Banks and lenders will likely do what they can to help prevent homeowners from defaulting until the risks become too high for them or OFSI decides for them that the risks are too high. Until then, it's not clear whether we'll see a wave of forced sales hitting the market. What does this mean moving forward? Well, the general consensus as of right now is that we are likely to see further rate increases. And as Royce Mendez, an economist from Desjardins, has said, it's unlikely they'll see enough progress towards restoring price stability before their next scheduled rate decision for this to be the final hike of the cycle. The next scheduled rate decision for the Bank of Canada is July 12th. Royce also said that they continue to expect another 25 basis point rate hike in July, which would take the policy rate up to 5%. So what plays out for the rest of 2023 is really up in the air. Do we see more rate increases this year? Do home prices stabilize again? Was this just a dead cat bounce and we're going to see big decreases again? In my opinion, it sounds like we won't be seeing prices decrease due to forced sales, increasing inventory on the market, at least not this year. It's possible the bank continues their aggressive campaign of rate hikes and that takes a toll on home prices again though. Let me know your thoughts in a comment below. My name is Jessie McClellan. I hope you found this video helpful. If you like this and other Durham region real estate content, hit the like button and please subscribe to the channel. Thank you so much for watching and I'll see you in the next video next week. Bye!